Hello everyone. This video is going to cover exercise 14.7b, preparing an inventory purchases budget. So we have Elgin drugstores and they sell prescription drugs, over-the-counter drugs, and some groceries. Purchasing manager prepared the following inventory purchases budget. For the year, they expect an ending inventory balance equal to 10% of the following month's cost of goods sold. And April's budgeted cost of goods sold amount to $37,500. So we need to complete this inventory purchases budget. All right, so budgeted cost of goods sold, they give us all of that. So we're just going to fill in what they've given us. All right, so we've got $50,000 in cost of goods sold in January, $35,000 in February, and $40,000 in March. All right, our desired ending inventory for January is $3,500. We get inventory needed of $53,500 because we add those two together. Our beginning inventory, they tell us, was $5,000 for a total of $48,500 worth of inventory needed that month. All right, so now we've got to figure out what's our desired ending inventory in February. Well, we got to come back up into the problem and look and see that they expect an ending inventory balance equal to 10% of the following month's cost of goods sold. So that means we need to look at, we're going to expect $40,000 in cost of goods sold in March. So to figure out our desired ending inventory, we need to take that times 0.1 or 10%. When you do that, you should figure out that February's cost of goods sold or desired ending inventory is going to be $4,000. Now, when we do the addition there, we find that we need $39,000 worth of inventory that month. So now let's look at March. Well, for March, we need to know our cost of goods sold for April. They don't have that information in this table. Where it is, right here. April's budgeted cost of goods sold amounts to $37,500. So if we were to extend this table to April, we would have $37,500. So take that times 0.1, and we should get $37.50 for our ending inventory in March. Add those together, and we get $43,750 for our needed inventory that month. Okay, so now we need to say, what's the beginning inventory for the month of February? They tell us in the chart that we started with 5,000 in January. Well, at the end of January, what do we have in inventory for the beginning of February? This amount right here. So if we want to end January with 3,500, that's what we want to begin February with. So minus that 3,500 there. And the same thing for February, for March. What our desired ending in February is what we will begin March with. So we found that desired ending down here is 4,000. So that's what we want to begin March with. Excuse me. And when we do all that math, we should find that we have $35,500 left, or we need $35,500 worth of purchases in the month of February. And then in the month of March, when we do that math, we find that we need to purchase $39,750 worth of inventory. So that's part A. So now for part B, we need to determine the cost of goods sold the company will report on the first quarter pro forma income statement. Well, simply take our budgeted costs of goods sold and add them together. So we get 50,000 plus 35,000 plus 40,000, and we should end up with $125,000 worth of costs of goods sold to put on that pro forma income statement for the first quarter. Now for part C, determine the amount of ending inventory the company will report on the first quarter pro forma balance sheet. Well, the quarter ends on March 31st. So then all we need to do is figure out what's the ending inventory going to be or desired to be at the end of March. Find that right there. So your answer to part C is simply that 37,000 or 3,750. So $3,750 worth of ending inventory on the balance sheet, because it's at that moment. That's what we will have left in inventory. And that is exercise 14.7b.